Exchange rates matter because, firstly, it's going to show up in a country's inflation because most countries in the world import goods from the rest of the world. Their local price at which they can import goods depends upon the value of their currency relative to the rest of the world. What we've always assumed is that prices get set in international markets in terms of the seller's currency, and it's a seller's currency price that remains sticky. So if I take an example of, say, Japan selling to Brazil, the assumption would be that the Japanese firm sets price in yen, and that yen price tends to be sticky. The Brazilian firm sets price in real when selling to Japan, and that real price tends to be sticky. But what the dominant currency paradigm tells you is that what really matters is the value of your currency relative to the dollar, and the value of your trading partner relative to the dollar, even if your trade with the US is a tiny fraction of your overall trade. So when Japan sells to Brazil, it's a dollar price, and the dollar price doesn't change. When Brazil sells to Japan, it's again a dollar price, and the dollar price doesn't change. So the dominant currency paradigm is about capturing the fact that the dollar gets used a lot in international trade, and importantly, in trade where the US is on neither side of the trade deal. The exchange rates also matter because it has implications for how much you export to the rest of the world. For instance, if I'm Brazil, the Brazilian real can depreciate relative to the Japanese yen, but still the exports from Brazil to Japan can go down. And the reason for that is because the Japanese yen has depreciated relative to the dollar. And as we know, countries have often blamed each other of engaging in currency wars because there's a very strong belief that exchange rate movements help a country in its growth prospects, which is why it's quite important to understand how does and which currencies matter, which is what my research is all about.